Hello guys, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Texas Pacific Land Corp, ticker symbol TPL. Texas Pacific Land Corp currently trades for $1,297.17. The stock is up 168.45% over the past year. The market cap of the stock is $29.8 billion. The price to earnings ratio is 66.54, and the annual dividend yield is 0.49%. Texas Pacific Land Corp is a really interesting company to me because essentially what the company is a company that has a lot of royalties on land in Texas. So they own 85,000 acres of land in Texas, and they're just hoping that there's some oil on there, and they're obviously researching and trying to buy land that could potentially lead to having some kind of resources on it. And then they're allowing other people, companies, whoever, to come and mine for those resources, and then they collect a royalty for every resource that's pulled out of the ground. And then what they do after they receive those royalties is they, one, pay a dividend, and two, they put it back into buying even more land. So then they could collect even more royalties, and then they could buy more land. And it eventually they'll just be like this giant hegemon type company in Texas that just owns all of the land for the resources and is just collecting royalties forever, basically. Or sometimes they can also just sell the land if it's overvalued or they made their money back on it and just buy even more. I think the company is going to have really long-term growth for a while. I think it's a very intriguing concept. And so I wanted to do a DCF valuation for the company and show you guys what I think a fair value would be for this company today. TPL. You can see various different things here. I have the stock ticker right there, for example. I also have an average revenue growth for TPL of 25.1% from 2020 to 2024. This is the trailing 12-month number right here for the free cash flow along with the revenue. And we can see that with an average growth rate for the next 9 years of 20%, a perpetual growth rate of 2.5%, and the discount rate I've applied of 6.7%, the stock has a downside of 5.9% to the current price of $1,297.17. And, I think that this is you're giving them a very high bar to hit with these kind of expectations. I mean, a 20% average growth rate is amazing for any company, but that would still not be enough to make this even fair value, let alone for there to be any upside. You're not even breaking even, according to the model, with these conditions, right? So I think that this is a really cool company. And I think if you're in for the long term, you'll probably make money if you hold out for a year or two and you don't care about the price. Then I think you'll start really being in the money. But I think that this stock is just, quite frankly, I'm not a financial advisor and this isn't financial advice, but the stock looks to be grossly overvalued given the current price compared to most of the multiples I have, because I feel like 15% is probably more reasonable, especially as you get into the later years where land starts becoming more expensive, or any number of different things could happen. You could have one year where, there just is a lot more scrutiny about oil, or a number of different regulations or different things or rules about, just how much money they get taxed on oil, or there's just a million different things that you can get into that could make the free cash flow inconsistent, is my point. I know I kind of went on a ramble there, but I think that the stock is very, very overvalued currently. It's obviously run down a little bit from here, and I think it's going to continue to go down. I think that you should look at picking this up around $800, maybe $900, but I still think you're probably overpaying for the stock, just because, I don't like taking risks. I don't think it's likely that they're going to be able to grow the free cash flow more than 20%. I just don't see how they're going to be able to consistently do that year after year. And I just don't believe that the stock is, something you want to be buying right now. If you already bought in, I think it's a great idea to just hold this stock forever, because I think if you can get in at a good price, this is a very attractive company because it's just going to be consistent for a very long period of time. You're just going to get to collect royalties. There's not really any, expenses going into the company other than land taxes, stuff like that, but they're just making money. I mean, you're not really going to there's always like a fair value amount that the stock has to be worth, right? So you do kind of have that insurance of, if you put into this, maybe over the long term, they will grow the free cash flow, and then the free cash flow will be big enough that the present value will be more worthwhile compared to the price today. So if this is a really safe, good company. So on the company side, it gets an A+, but on the actual value side of the company, it gets like an F. It's way overvalued for what it is. That's kind of my review. I think that the $750 to $800 mark is where you can start buying this stock up. But, it's unfortunate that it had to be like this, but it's overvalued. And that's the review.